Hey everyone, Safi Russell here, founder and CEO of SDR Consulting Inc. Today I want to talk to you about how you pay yourself as a business owner. If you are currently structured as a sole proprietor or an LLC and you're the only member, then the way you pay yourself is not structured, right? I do suggest having a separate business account where all your business related transactions run through. And then once you determine how much you need to pay yourself to maintain your essentials, your wants, you're paying down your debt, all the various things you need to handle personally, if your business has enough to cover that and still maintain its operating costs, you can simply write yourself a check from your business. You can do a wire from your business account to your personal account. You can do a Zelle transfer or a bank-to-bank transfer, depending on your bank that you use. So it's very informal how you pay yourself when you are in those business structures. You are not taxed based on how much you're paying yourself in those structures. You are taxed based on how much profit the company makes. So whether you leave that profit in the bank or you take that profit out and put it into your personal account, it doesn't change how you're taxed. So it's not really there's no formal way to pay yourself in those structures. So how much you pay yourself is based on how much you need, right? That's step one. And then what your goals are, of course. Okay. If you're set up as a partnership, a multi-member LLC, or other partnership. In those cases, you're taking what's called a distribution or an equity withdrawal out of the company. And usually those structures have an operating agreement or partnership agreement in place that specifies how each partner can take those withdrawals, okay? So that is the document that will determine how you pay yourself or how much you can take out. It's going to be the same idea where it can be a check, it can be a wire or what have you. It should be something that could be tracked, but how much you can take out is going to be determined by the agreement that you have in place with your partners, right? So you wouldn't want one partner taking out more than the other when you both are 50-50, as an example. If you're taxed as an S corporation, the way you pay yourself is more structured. So you want to have a reasonable compensation in place for yourself as an employee of your company, official W-2 employee, connected with a payroll service, issuing yourself a W-2, taxes being taken out during the year. I have plenty of topics on that, okay? And so you're going to pay yourself that way. However, you also can take what's called distributions or owner draws out of the business account by check, wire, Zelle, what have you. How much you take out in, that way versus wages, an analysis needs to be done to determine that, but you can pay yourself in those two ways when you have an S corporation and it is more structured, okay? Lastly, if you are a regular C corporation for whatever reason, you also are supposed to be set up on salary, paying yourself a reasonable wage for your position. And in that case, with a C corporation, if you did take money out of the business, it would be considered a dividend, which is taxed twice. So you want to be wary of that. So how you pay yourself is dependent on how your business is structured. And you want to make sure you're working with a professional to guide you in that properly so you don't generate or cause potential IRS red flags by improperly paying yourself. Okay. Hope that helps. Stay tuned for next trainings and talk to you soon. Bye-bye.